My husband's father wants to sign his house over to us. I like your in-laws. My husband's sister also owns 65% of the property. What tax advantages are there for us, his dad, his sister, and what tax issues does it raise for us? Should we start an LLC or some other structure? What do you think?
Now, I can go one of two ways with this, depending on what this house is. If it is his principal residence versus maybe a rental property he owns that he just wants to get rid of. I'm not a fan of signing over a principal residence to my children.
Is it his house? Like, I don't know if these people are on.
I don't know. Yeah.
Is it his personal residence or is it a house? Because if it's personal residence, it sounds weird because the sister already owns 65% of the property, which means she has the right to occupy the house too. You're all beeping like crazy. Somebody's trying to get you. Let's see. What tax advantages are there for us? Really none.
No.
Unless it's an investment property, but then you're getting his basis if he gifts it to you. So like if dad's owned this for a long time and he's like, hey, I really want to get this house over to you and your sister.
And we see that so often that I've owned this rental property for a little, I don't want to deal with it anymore.
Here's the thing. If dad passes away with that property, your basis steps up, which means if you guys sell it, or if in this case, your sister already owns part of the house. So it's what is that? 35% of the house that she doesn't own. Now you own it. You wouldn't pay any tax on 35% of that income, that the portion that came to you. You wouldn't pay any tax on it because the basis would step up when he passes. So everyone, when they pass, your capital assets step up to the fair market value of that asset on the day of the decedent's passing. So dad passes away, you would have no tax on that sale. By doing this, and he gives it to you, you have his basis and you lose the step up. So dad gives it to you before he passes. He says that I'm doing a great thing. You just made it all taxable. And so I share, I know I've shared on the show a few times, but there was four brothers and sisters, and dad had a building in a major city, and it was worth tens of millions of dollars, but his basis was really low. In fact, he depreciated most of the thing. The land was like $100,000 basis when he bought it. He had it for like 30, 40 years. The accountant transferred it to the kids via an entity. They used a limited partnership, and they filed it as gift tax returns on it, trying to avoid dad getting hit with the estate tax. Dad passes away in a year where they had no estate tax. Kids now had 20 million bucks or whatever it was millions of dollars of taxable gain when they sold that property. They would have avoided it entirely. So they got hit with, I think the tax bill was close to 6 million bucks that they would have avoided. So, ouch. So somebody says, so dad needs a living trust, put the property in the trust, easy passage after your passing. Then it's clearly the intent of dad, not up to the brother and sister arguing, thinking about my sister. Absolutely. But it sounds like he already gave it to sister.
And I'm just going to bring that up. If he gives you the other 35%, your sister's going to be the majority owner on this.
Yeah.
And can make all kinds of decisions without your input.
Now, I would, the workaround is you put it into an LLC and you make brother and sister co-managers. But at this point, sister's going to have to agree. Yeah. She already has the 65%. Is why you unfortunately, it's like you talk to lawyers before you do this, so they can ask you all the nasty questions of how do the siblings get along? Are they going to be nice to each other? Because if they do this, and you say, hey, you're co-managers, but your interests are different. And then you could say, in order to make a change, 85% of the membership interests have to agree. Now you just made it to where sister can't bully brother, but brother also can't bully sister. They're co-managers.
I think if it was me, I would also consider, if I really don't care about this property, going ahead and taking that gift interest and turning around selling that interest to my sister. So then she becomes 100% owner, and I've washed my hands of it.
Could do that too. And just say, hey, sis, do you want 100% of the property? Dad gave me 35, but then you have gain. You're going to
Yes.
pay tax on it. It's
Yep.
just so much easier if dad held on to it and just gave it to his kids when he passed and, held it in trust, allowed a
Yes.
trustee to make that decision. And then they could distribute, they could manage it. Here, I'm going to distribute 65%. Now, if it's a residence, primary residence, and this is the house they grew up in, and maybe you're like, hey, I want you to live here. Now you're going to have the issue. You're going to have brother and sister kind of at odds. Who
Mhm.
gets to live there? All that good stuff. Who's paying for the utilities? Who's paying for the upkeep on the house? Sister's residing there. Brother's not going to be too happy kicking in a bunch of money every year. So it's probably better under those circumstances to give it to sister and find some other way to take care of brother.
So this question wasn't asked, Toby, but dad owns 35%, sister owns 65%, and saying this was dad's primary residence. Is he excluded from 121?
When he gives it away, he's excluded from 121. With the sister, if she lives there, you could still get 121
Okay.
because it's name on title,
Yep.
so brother and sister, and occupancy. So yeah, it's like you could still do it if they both live there. It's just like cohabiting adults who jointly own a property. They could both qualify, but they each get the 250,000. I mean, there's other questions. Somebody wrote in there, said sister's supporting dad, here, let me give you guys a horror story. This is not necessarily related to the tax, but I lived this. It was on my mom's side of the family. Great aunt took care of great grandfather. Great grandfather passed, left everything to great aunt. Great aunt got married. Great aunt passed away. Everything went to husband, who was not a family member. Grandpa never intended. Great grandpa wanted to keep it in the family, and it ended up out of the family. In fact, my mom and her sister had to go bid on the sale of the estate sale to get albums and things like family albums, things like that. They wouldn't even just give them. They were absolutely turds. And it wasn't the gentleman was older. He was cool, but he didn't document it either. So great aunt passed away. He inherited. He said, "Oh, don't worry, we'll take care of it. We're not going to. We'll make sure you get your stuff." And then he passed away, and his kids were absolute turds. So it gets a little funky monkey. So that's why when somebody said do the living trust, yes, document who gets it, appoint somebody who's in charge, easy peasy, keeps, and brother and sister don't fight. And because if they do, they get disinherited, then you could do it. Somebody's asking a question. This might be relevant, so just give me a second. I don't know if oops. Somebody says that's how my family lost its thousands of acres of farmland that it had collected since the 1600s, and it got pissed away. Yep, Don. We see it all the time, and so people are always like, "Oh, it's complicated." It's not complicated to guys like us because we see it and we could say, given the question right now, what if a business property is inside a trust and one parent dies and the other has Alzheimer's? Can there still be a non-taxable event if the property is given to the kids while one parent is still alive? Currently, the trust resides in her name, but is managed. So one parent dies, depending on the state, you may have a step up in basis on that date. If it's a community property state. If it's a separate property state, parent one passes away, there's a step up on their interest and the other part doesn't. But mom has Alzheimer's. So in a living trust, there's a trustee who's managing that property for their benefit during their lifetime. I wouldn't give it to the kids because there's no reason to do it while the parent's still alive. And so when mom passes away, sounds horrible, right? When mom passes away, step up in basis for the entire thing, sell it then, distribute it to kids. While mom's alive, if you want to sell it and distribute it to kids, there's a reduced taxable event, right?
In my experience, anytime you have somebody with dementia or some other form of brain impairment, you really need a conservator or guardian for that person, and it probably shouldn't be any of the beneficiaries
to
their estate.
Yeah, well, sometimes it's going to be one of the kids, but then you should probably have a different trustee if that kid is also one of the beneficiaries. Beneficiaries can change the trustee, by the way, but they can't tell the trustee what to do. the trustee follows your written instructions. Somebody says, what if your lender won't allow them to put a rental property in an LLC? Your lender can't stop you. The lender can do a due on sale, but we just use a trust, and that usually stops it.
Yeah, I find that, I know this is a different question, but I usually find it easier to form the LLC than buy the property.
Yeah. Or just work with portfolio lenders as you get big.
True.
After you get over your first 4 to 10 properties, you're going to be doing portfolio loans anyway, or folks that are recourse. That was so helpful. The dad just passed at 96. Thank you so much. Thank you. Yeah, I'm glad we were able to help. Yeah, this stuff's serious. You know, we joke a lot, right? We try to keep it light, but this type of stuff, you really have to sit down with somebody. A lot of times we just take action. There's a lot of folks that will just transfer things to their kids. Unbeknownst to them, kid has huge liability. They have a judgment against them and other stuff. You just gave them an asset. Now they go to take it from you. And you didn't even realize that you exposed yourself to all that fun stuff. Or you do it and you put your kid on it, and then something happens on the property and the kid's liable, you're liable, everybody's liable. And you didn't think of all the bad things that could happen because you were trying to do something like, oh, I know there's something that I should do. But sometimes it's just, hey, give us a call. That's why we're here. We'll make sure that we'll get you some, straight answer so you can make a very intelligent decision and that you don't do anything that ends up hurting.
And it's really hard when you lose a loved one. You got enough on your plate already.
Oh, yeah.
So please don't be afraid to ask for help from whether it's a close, knowledgeable friend or from a professional or something like that, because it's frankly too much for most people.
Yeah.
To deal with financial, the legal side, and the death of your loved one.
It's not a good use of your time either. If you like this clip of Tax Tuesday, then I invite you to join the actual show. It's every other week, and you can ask your questions and get them answered live by myself and my team. Just click the link.